Hmm. Very good. Okay. Welcome, Marcus. You don't have to unmute, just saying hi.
Hi, Peter.
And Tony, a local,
Hey Peter, how's it going?
actually pretty damn well. Thank you very much.
All right. I gotta say the same.
Awesome. I'd love,
Yeah.
when we get online and say hello, maybe if you have something to share, feel free.
Okay. Yeah, well, it depends on the subject matter, but yeah, I have a lot of things to say about money. I think most of us do.
True enough. There is a lot. There's a lot. But any win is a good win.
I think it's about gratitude for what we have is the foundation for creating more. Sort
Oh,
of that.
oh, really
Yeah.
good point.
Anyway, I'll let you get ready for your show and looking forward to it.
All right. I think I brought the dog and the pony, so we're good. Okay. I should have some opening music or something. Do the money dance. Who's pulling the strings on your money dance?
Hi, Peter.
Good morning, Sid, or good evening, good day.
Late at night. Peter, I left a message for you in our Signal thread, but I can just recount what it was. I said, if with your permission, I wonder if you'd be open to just doing a quick, I can do it, a 2 minute screen share, just to show people where all the video recordings are and the Zoom links are, because I think some people might not know where to find it. I saw Tony do a post, so I thought it'd be good to just give people a little tour.
Sure, I can make you a co-host here.
Mm.
Welcome, welcome. We have Sid and Benny and David and Jared and Marcus and Neil B and Philip and Tony and no El Roberto, but he's probably doing El Roberto things. Um, Good day to you all. Let's get started. This is session 3, and we're starting to dive into the real meat of our work. And today we get to talk about one of my very favorite topics because it's so powerful and it's so interesting, I think. It's called behavioral finance, and it's all about what we bring to the table as humans with our thought patterns and emotions and so on. And an understanding of those gives us a lot of power over ourselves and by extension, the world that we create for ourselves. So I'd like to give Sid the floor here to start because he wants to show you all how to access some of the materials from this course, including articles and videos and things like that, recordings. So Sid, take it away.
Hi, gentlemen. I asked Peter if it'd be good to just do a 1 minute quick tour of our private space for this challenge on Integration Nation, just so that we know where to find things. I know people had questions. So on Integration Nation, on the left, right, there's a section called Subscription Upgrades. All right. And the Money Mastery Challenge private space is here. You see a bunch of different things in my account. That's because I just have host access. But if you're registered for a challenge, it'll appear under subscription upgrades and it has its own private space. Right. So if you click on it, it'll get you to the Money Mastery Challenge space where we have our private feed on top on the left. And then next we have course resources. This is where once Peter shares the video link, I post it here. All right. So these are on YouTube, but they are unlisted on YouTube. No, like the world can't see them. Only people with the link can watch these videos. So these get added here in the course resources. And then under challenge calls is where all of the upcoming calls for this challenge are listed along with their Zoom link. So if it functions like the rest of our calendars on Integration Nation, but it's only accessible to the people in this room since we signed up for it. So those, just so that you know, if you ever are struggling to find the Zoom link or a video recording, this is where it all is. That's all I wanted to share. Thanks, Peter. Any questions?
That's really helpful. That's not intuitive that they put it under subscription upgrades. Oh my goodness.
We've experimented with a few names. I feel like we keep changing it till it becomes intuitive.
Okay. I didn't mean to cast aspersions on anyone who might be on this call. I did not. Okay. Anyway, we appreciate the guidance and the amazing, clear explanations that you provide. So, trying to find my cursor. There it is. Cursor's foiled again. I'm going to slip into controlling the screen here, and let's dive in. And I'm going to look at chat just in case. Okay. So I'm sharing my screen. And you should see the Money Mastery slide here, the home screen. I guess I can make that slightly larger. All righty. So as I alluded to, today we're going to talk about the role of emotions and the role of heuristics, which are thinking shortcuts that we all use to keep life simple and be able to handle complex things going on. We have little shortcuts in our ways of thinking. And all of this boils down to something that we call behavioral finance. And behavioral finance is the study basically of irrationality in our financial decisions. A lot of us guys like to think that we're pretty rational and intellectual about things and logical. The truth is that that's not so much what's really going on. We're driven by emotions largely, and it's good to have an understanding of what our potential shortcomings might be so that we can avoid them. And we'll get into that. So this is my favorite topic, I think, is about the human side of money. And there's a lot of talk about behavioral finance and the cognitive biases that we all have. But there hasn't been a lot of talk about how to deal with those biases. but I'm going to give about equal weight to both today. And this this is great stuff, man. This is really good. So, uh, there's an emotional side to money, uh, such as fear, such as greed, such as overconfidence, as mentioned here. I think you guys probably already know that and have heard of it. For example, people tend to hold on to losing investments longer than they should because of the emotional need to recoup losses. So, loss aversion is found to be about 3 times more powerful than um, the greed side of the equation. The fear side really gets us and grabs us by the throat. Also, there's a phenomenon called anchoring. And I'm going to use an example of a client that I have. When I first met him, he had $100 million, and it was in a single stock, if you can believe that. And it was leveraged. So he had invested in a way through options to magnify his gains. Well, this particular stock has fallen on some pretty challenging times. And I won't name the stock and I won't name the person, but it's way down. And what I wish people would do is just put aside enough for the rest of your life. If you have $100 million, play with the rest if you want, but don't play with all of it. So he has found himself in sort of a cash crunch as a result of writing this thing back down. But it was up here a couple of years ago. I'm just waiting for it to get back there. It'll get back, falling in love with a stock. So these kinds of biases can have a huge impact on our lives. So how many of our decisions are based on emotions? I'm just going to lay it out there to save time, but it's not 50%. It's not 25%. It's not 75%. It's estimated to be about 90% of our financial decisions are influenced by emotions. We like to think that we're logical and that emotional factors don't play a role, but they do. So obviously, market swings, market crashes, personal financial crises, um, and the hidden motivations we have in our spending and our saving and our job searches and so on. The emotions play a role in all of that, which is normally good. But unfortunately, with money, it's a different world. I like to say it's a second order problem because if you're talking about investments, understanding a certain industry, understanding a certain product, even knowing that there's going to be some kind of a breakthrough product coming from your favorite company, that doesn't predict the future. Knowing the real world is not a completely reliable guide to what goes on in financial markets because you're dealing with people's feelings and opinions about what's going on. You're not dealing with reality. In the long run, things do tend to even out to the point where real value is reflected. But in the short run, there's all kinds of swings that you may not expect. So this is a humbling realization. But what are we left with? We're driven by emotions, and um, logic really is not all that useful. It is if you're talking about the big picture, but when it comes to individual decisions, the emotions do get in the way. So we're going to talk about heuristics today. That's the shortcuts that we use to make decisions. And we'll talk about some of the biases which we use to save energy, save time, and make decisions. So common heuristics, things like overconfidence. You believe you can beat the market or you can time it. Again, you're dealing with a second order problem and you don't know what's going on in other people's heads. So even having a lot of knowledge doesn't guarantee anything here. Confirmation bias, believing is seeing rather than seeing is believing. When we believe something, we tend to find evidence to back it up rather than being curious and wondering, and staying focused on the question rather than jumping to an answer. Anchoring bias is another example, like my friend who can't wait for his stock to get back to the level it was at a couple of years ago. It may happen, it may never happen. It's a great company, it's amazing, but that doesn't mean that things are going to go well for it. Lots of things can happen in the regulatory sphere, uh, personalities, politics, technology, all these things are influencing that particular company. So, any questions about this foundation that I've laid, that emotions play a role and that we have shortcuts that may not serve us in a complex world? Okay, so welcome to behavioral finance, where we throw out the old notion in economics that individual economic players are rational. So some of the kinds of biases that are out there, just run through them quickly. Loss aversion. So this leads to selling when the markets are at the low points, panic selling, um, narrow framing, making decisions without considering effects on the overall portfolio or on long-term plans, anchoring, hoping that things will go back to where they were, um, mental accounting, the ways that we pigeonhole experiences we have um, to back up what we believe and what we want to believe, lack of diversification. Um, Gee, I've got 5 index funds. I'm diversified. They probably hold pretty much the same thing. And it ignores bonds and it ignores foreign investments. A lot of these things are tied to investments, by the way, but I think it'd be really fascinating. I don't think there's a lot of literature yet that these biases also hold in other areas of finance, not just in investments. Herding is really, really an influencer. As humans, we're designed to stick with the herd. So the herd has a lot of wisdom. And that's really good if you're talking about looking for safe water out in the desert. If you find an oasis and animals and people come there to drink, you can assume that because they're there, it's probably a safe source. And in the physical world, I think that holds true. But in the abstract world of money, unfortunately, even though it's warm in the herd, as they say, the average investor does get swayed by emotions. And that just leads us into the herd mentality, which often is going in the wrong direction when it comes to investing. So everybody else is doing it. Oh my God, I got to jump on the bandwagon, either getting in, getting out. This company is great. AI is the future. I agree with that, but I don't know if it's going to be a profitable sector. It's kind of a generic, uh, what do they call it? Can't think of the word, but I think you know what I'm saying is that um, there may not be a lot of profits or there's a lot of competition. Um, Regret, you know, carrying the old disappointments with us and having that keep us from taking action that's appropriate. And media bias. So the more we watch the media, the more we're going to be influenced by it. And man, that's not a place to go for investment decisions. Might generate a few ideas, but the emotion of it, the selling that's behind the scenes, the biases they have. Let me give you one example. I heard this from a media panel. We had people from the New York Times and Barron's and so on there. They wanted to create an article about the top 100 planners in the country. How did they create their list of the top 100 planners, you might ask? Well, they looked in their Rolodex and pulled the names out, and those were what they published. So take things with a grain of salt, for sure. So the media is probably not the place to dwell too much, not good for our mental health in so many ways. And optimism, overly optimistic assumptions tend to lead to um, big disappointments when they don't go the way that you expect. The biggest cognitive biases I see in my clients over the last 40 years, people follow the trends. If the market's been going up, they expect that to continue. And if it's been going down, they expect that to continue to the sky, to the infinity, to absolute zero. And if you're diversified, zero isn't happening um, unless we turn into a communist country, but we won't go into that realm right now. So I call it driving with their hands on the rear view mirror. You're looking backwards, you're not looking forwards. And it's harder to grapple with those notions of where's the market going to go. Actually, I would just argue that you can't know that because humans are unpredictable. We have free will and we have irrationality. So don't drive with your hands on the rearview mirror. Keep them on the wheel and look out the windshield. That's why the windshield is bigger than the rearview mirror. We're going forward. I still have clients who come in and if they need to raise cash, they say, well, let's sell something that isn't doing well. That would make sense in the physical world. But in investing, if you're diversified, you should do the opposite. You should sell something that's doing well, not something that's not doing well. Because you want to harvest gains or you want to sell high and buy low. But human nature is sell low, buy high. And that's why people have this thing called the behavior gap that costs them probably most of their profits that they could have had if they just sat still. Another thing that I hear commonly is, I'll just wait to invest until things look better. I don't know if things have ever looked good. You can always find the negative. Um, the markets are going to move before things look better. There's wisdom in crowds, and somehow the market sense what's going on in real time and it starts to move. And if you wait for it to look better, you will be too late. Recoveries tend to happen suddenly with the most momentum in the early days of the recovery. Of course, there's the ever famous, what if the market crashes? Yeah, it will. About every 3 years, you'll see a drop of 20%. Has it ever gone to zero? No. Is it at all-time highs? It reaches all-time highs on a regular basis because the trend is up over time. So all of these things lead us into bad decision making. You guys have anything to share about that? I've been rattling on for a while. Okie dokie. All righty. So equal time to the solutions. How can you minimize the negative impact of behavioral biases? This is great. It's kind of a fit with the men's work and the No More Mr. Nice Guy work. It's rising above who we are as a default and taking control of our lives, basically through being healthy and clear-minded and thinking about the bigger picture. I think those are kind of the general guidelines. So I have articles that I'm going to share with you guys in a minute through the chat, and I'll post them to the website. But some of the highlights are some of the areas where we can push back against our unhealthy biases and emotions is to develop and adopt rules-based systems, like putting a stop loss on the stock or waiting until something gets down to a certain value where it's a bargain before you buy it. Or whatever your rule might be, but having some kind of a rule and then following the rules. I knew a guy who made his living as a trader for himself, and he had good rules, but he consistently broke the rules because he thought he had some special insight or feeling, and he just second guessed himself to death, and literally to death. He wound up committing suicide. So I don't know what other problems he had, but I do know that he struggled with trying to stick to his system. So this requires really careful groundwork, really thoughtful groundwork, and sticking with it and remembering that that discipline is your savior. Recognize your limits. We don't know what's going to happen next, like I've said a number of times here. We're not God. Even if we work for a company and we have insider information and so on, lots of things can happen outside of the company that would affect company stock, for example. So be humble and recognize that you don't know what's coming next. They're long-term trends, but in the short term, very hard. So again, I like the rules-based systems focusing on a process and not the outcome. And I think about Dr. Glover, and I think about it's how we approach the women, not how they react, right? We can show up, we can do our job well, and if we don't worry about the outcome or trying to manipulate the world around us, we can do so much better job, and the outcomes take care of themselves. We're not in control of those. So have processes. You're beginning to grasp the role of emotion in 90% of decisions. Just realize that's there. Quick story from a Nobel Prize winner that I interviewed for a podcast. He said they took a group of people and had one half of them do simple arithmetic problems in the laboratory. Then they brought in the snack tray with fruit and good things on one side and some chocolate cake and not so healthy things on the other side. The people who did the easy mathematics, the arithmetic, they stuck to eating fruit and healthy things when they got the snack time. And the people who did the hard mathematical problems went for the chocolate cake. So what does that mean? It means that when we're tired cognitively, we don't make good decisions. We tend to just say, the heck with it, I'm not going to wrestle. I don't have any mental energy left. So to conquer emotion or to pull it into line. I think we need to take care of ourselves and do the planning when we're calm and when we're not impaired in any way. And that's, I think the best thing to do is make the decisions early, like soldiers who think about, well, what if, what if I'm in a situation where I have to sacrifice something like my arm is stuck somewhere, cut off your arm and survive that way, even though it's something that's difficult. That's a bit extreme. But if you plan ahead and you have your plan in place, it can get you through those times that are emotional. Embracing simplicity, behavior overcomes intelligence. I would rephrase this as systems overcome I want to say, speaking of tired brains, I apologize. Systems are far better than willpower. Willpower is very limited. It's overvalued, I think. It's not all that great, but if you have systems, you don't have to think that much and you can follow rational behavior. Harnessing the power of loss aversion, I said that we're 3 times more emotionally influenced by fear of loss than we are by hope of gain. So this points to the need for the discipline that we have and that we're developing and the systems that we're developing. So it doesn't have to control your life. It just points to the importance of having those systems, if that makes sense. Seeking behavioral support, that's what I do as a financial planner. I'm probably 3% of our return that we give clients is because we help them stay put when things look ugly, and we help them stay conservative when things are looking great. People really want to jump into things that have done really well lately. So we modify the behavior. And it's a tough job because we have to say, no, let's say, don't invest when things look great and do invest when they look rotten. That's a tough sell, but it works with people. We need that behavioral support outside of ourselves, I think. Investing in line with your values helps you stick with your plan because you have other reasons to be in it other than the monetary motivation. And limiting our intake of financial information and financial pornography is so important because that tends to sway us. And it's presented in an emotional fashion in the media for the most part, which is really, really dangerous to our financial well-being. So let me share those 2 articles with you guys, and then I'll come back for questions. Get into my, very good. Chat. Good. So this first article that I'm going to upload, and this is in Word format, is basically a summary of can't share a Word document. I'll have to turn it into a PDF and share it later. So I apologize for that. The first article is about the work of a guy named Meyer Statman, who's a professor at Santa Clara. And he's one of the top 5 experts in the world on behavioral finance. And the summary I put together talks about ways to overcome biases that we have. So again, it's on the solution side, um, acknowledging our emotional biases. It has real world application and academic references for each of these. Automating decisions to mitigate emotional reactions, diversification, which means less volatility in a portfolio, means more ability, more opportunity to stay calm. Number 4 here, set financial goals and focus on long-term planning. Understand financial well-being beyond wealth and pre-committed strategies to stay disciplined. Financial professionals as choice architects, reframing biases to change behavior. So the context is decisive, as I said in an earlier session. So that's one of the articles. And the other one is focusing on the work of a guy named Daniel Crosby, who's quite well known in the investment circles that, professionals like me, we see him at conferences all over the place. And he's done his own thinking on this and has some overlapping, but I think some unique points to make. He talks about adopting rules-based systems, recognizing your limits, focusing on the process and not the outcomes, embracing simplicity. That's where I got some of my points. And behavior overcomes intelligence, seeking behavioral support, and so on. So maybe at the end of the call, I can save those as PDFs and upload them, but I will definitely do that. Any thoughts or comments on this? Is this useful? I know I'm going over a lot of stuff, but with the articles and just your awareness, I think you're going to start to tune into this. Philip,
Hi, Peter. Great to see you.
thank you.
Enjoyed this lesson. And it rang true for me because 3-4 years ago, I dabbled in trading, specifically sports trading. And I realized a lot of these issues come up when I was making loss after loss after loss, and all the biases, all the things that we talk about, I mean, you just talked about. And yeah, I'm just sitting here thinking to myself, yeah, I wish I knew this earlier at that time. I wouldn't have lost those thousands and thousands of pounds in trading and being emotional about it. Yeah, so it's just a very useful reminder going forward as well. And I recognize a lot of these things. So thank you, Peter.
That's about the nicest compliment I could get. Thank you, Philip, for sharing that. I hope that it comes across, and it sounds like it is. Benny.
Yeah, can you hear me?
Yes,
I thought
sir.
I thought I had echo. Never mind. I let money manager experts manage my money. Infidelity, I buy these mutual funds, invest in 401k and all, those index funds. I don't worry about. I can take care of all these minimizing negative impacts that you have listed there by letting an expert manage it. That know more of it than I do. That's it.
Yes. Hopefully that person has the training and the experience. And it sounds like you've picked somebody that you're very happy with.
Well,
And
I don't know any person. I just depend on Fidelity to do it, and they've done it in the past 15 years.
wow.
Right? I mean, if they're not a competent money manager, they get fired, right? I mean, it's Fidelity. It's one of the big monoliths of financial services.
They are. I think they're probably number 2 in assets after BlackRock. They're huge. So I'm glad that that's working for you. That's terrific. And you can hear the peace of mind that Benny has because he's separated himself from even having to be involved in it and make a lot of the decisions. And he has someone to turn to if he has questions or concerns. Sid.
Hi, Peter. Peter, my question is about financial porn that you mentioned, right? I mean, I'd like to imagine that I have a pretty sound group of people around me who I go for financial advice,
Uh-huh.
right? And even within those, like sometimes I feel like I get contradictory advice or investment ideas, and I wonder, even having sort of really narrowed my sort of board of directors down to probably a handful of people, how do you sort of manage that bias of and sift through, build conviction around ideas without letting sort of contradictory advice bother you? So that makes sense.
Yeah, it does. Uh, it sounds like you have a core group of people that you either talk with or listen to.
That's
Uh,
right.
so if I were designing a castle or a fort for you, I'd say those people that you listen to a lot should be vetted over time, uh, that you've selected them because they are good sources and make that your
Mhm.
core. I think it's okay to dabble and listen to some outside ideas. Um, that you select, and then, maybe it's inspires you to pursue some, we call them sometimes core and satellite portfolios. The core, you've got your meat and potatoes, and occasionally this appetizer comes along, looks good, but that's a certain percentage of the portfolio that you can play with and put at greater risk. It's kind of fun, but recognize that that's playtime.
Yeah. Well, what's your advice on what's an ideal satellite portfolio size as a percentage of your entire portfolio?
All that depends on the person and what their needs are. I've had clients who had so much money they didn't need to use their portfolio at all. Even so, I had a woman who was approaching 100 years old and she still had about 90% in stocks because she
Hmm.
was comfortable with it. She had low cost basis. Um, Most people, I'd say 5 or 10% of the portfolio. It doesn't
That
take a
makes sense.
lot to sort of satisfy that sample, the taste. If you're eating a great meal, but somebody offers you a bite of theirs, you take one bite. It doesn't have to be a lot,
Mm.
but
Right.
there's no ideal number for that, unfortunately. And I was going to say your core group you trust, old, reliable, you can go and maybe get bounce ideas off of them and check things out. Then the playful part, but then there's the porn, which
Mm.
is uh gee, Nvidia's up 150% this year. Or you got to have gold because the world falls apart. It's like, okay, uh I don't know if somebody's going to trade a gold coin for the latest animal they've killed for food when you're out in the jungle. Like, not, I don't know. Um, but just be aware of, maybe even we could in our minds have like different tiers of trust. I mean, that's an idea I've never heard, but seems like it might handle it. Ari, would you like to ask your question or make your comment?
Yeah, it was about loss aversion. I think this is particularly strong for nice guys. I don't know, I'm thinking about nice guys I've worked with and probably even myself, like who just do not want to leave a relationship that's bad for them because they can't envision something better. So I mean, I think it comes out in different ways in their life. So I was curious about how do we harness the power of loss aversion? I wasn't quite
Yes.
clear on how we harness that.
First of all, yes, as I was doing the research for this, and there's a slide toward the end, that nice guys do have an aversion to risk that's in some ways higher than average. I guess we've been burned or something, or we just don't trust as much. I'm not sure but we'll find that quote as we go through this. Harnessing the Power of Loss Aversion 2. I have a quote on that. Let me read to you what Daniel Crosby said about that, because it's better than I can put it. Crosby believes that loss aversion, while often seen as a negative bias, can actually be used as a motivational tool. People feel the pain of losses more acutely than the pleasure of gains, so using this to stay committed to a plan can be effective. If the example is, if an investor is motivated by avoiding loss, they can frame decisions in ways that help prevent long-term damage, like sticking with a diversified portfolio to avoid the loss of potential future gains from panic selling during a downturn. So I guess when the loss averse person starts to encounter losses and feeling the pain or the anxiety from that, they can turn to the comfort of knowing that they've taken the steps to protect themselves from that. And the short term and the long term, separating those out. Been lots of downturns in the market, but there have been more upturns. And knowing the longer you're in, the more likely you are to be ahead of where you started.
It's kind of knowing what losses to be averse to, as
Mhm.
opposed to just avoiding loss aversion. Is it?
Yeah. And knowing that there's always risk in investing. I don't want to make it too narrow. It's not all about investing. It's about spending and tough conversations with people and things like that we'll tackle in future weeks. But it's having those plans in place, and I sort of lost my train of thought. So sorry about that. I'm gonna I'll get back to you, Ash, in a second. At the beginning, I was going to share with you guys that I have not been present online participating and generating content. I'm going to be more available, but it's tied to a financial victory that I've had. I was busy in the last 2 weeks with a ultra high net worth family who had a conflict going on, and they frankly were talking about going to court, suing each other. They couldn't be in the same room together. I worked with a colleague last week, and the week before we interviewed everybody first, but we got them all into a room together. And that family now is totally in love with each other again. And I'm just jazzed about that. It's my calling, and this is the first time we've had working with a large family. And I made $13,000 for the work I've done so far. And then the next day they said, we want to do our next step with Peter and Nancy again in December. So this is great, making money, doing what you're passionate about. But it has pulled me away from being present for you guys, and I apologize for that, the online part. But obviously, I'm going to be pretty free through the end of November when this ends. So, Ash, why don't you go ahead?
Thank you, Peter, for giving me an opportunity to connect with you guys. And thank you for everybody for being here.
You're a little muffled. I don't know if you could speak up or more
Can you
clear.
hear me now? Is it better?
That is better. Thank you.
Okay, I think I gotta get my mic closer to me. So I guess I'll get to the point quickly. I'm in my 40s. I have a nest egg with, just like Benny, with other institutions. I know you can't give any personal information. I think it's going to be a consult again later. But I think looking at all your information before with all these biases and all, I mean, I think everybody goes through these biases. I think the purpose of me coming to this thing is just to understand if there's any other strategy which I should utilize uh, for my future investing. Like, what am I doing? Why am I putting this money with these investors or these institutions? I mean, essentially, my idea was to just put a nest egg there and then kind of like let it grow on a broad-based fund with low costs on it. I don't usually shuffle my portfolio at all. So I was trying to figure out if you have any other options, like big thinking kind of a thing, where like I'm taking this money, I'm doing this to do this, I'm bringing it back again, or any strategies long term. I'm 45 now, so I have another, let's say, 20 years horizon to retire and all that stuff. So essentially my idea is to just retire with this investment portfolio money coming in my returns. I don't need to work kind of a strategy. That's where I am.
Well, it sounds like you could use an hour with a financial planner to, first of all, elucidate your goals. Sounds like you're focused on retirement, which is number one for sure. In general, if I gave advice, it would be to be dollar cost averaging, which means investing a certain amount on a regular basis and not letting market movements sway that at all. Just put it on automatic so you don't even have to think about it. Because when the market goes down, you're actually getting better prices. So just keep being consistent. Understand that drops happen once in a while, but you don't need to worry about it if you're diversified. Rebalance and look at the long-term returns in the different asset classes. Stocks have been the best returns in the US, even in fact quite a bit better than real estate over the long haul. In general, obviously exceptions. And if you want to do some projections of how much you might have and how much it might produce in income when you retire, so that would be retirement planning. Monte Carlo simulation can give you a best and worst case and average scenario. And you can build in other rules once you do retire to help ensure your success. So I don't know if that covers anything that's useful to you.
It does, Peter. Thank you. Which I do actually. I'm in Fidelity too. They automatically give you how much you need if you're retiring, or if you want to retire early too. So those are already there. But I guess my question is like, in addition to the stocks, which Fidelity gives you, what other things? Real estate is another investment area which asset class which I'm investing in. Crypto obviously is my worst enemy. I don't go there at all. But are there any other? I mean, you have commodities and gold and all that stuff too. I'm trying to learn, like, are there any other broad strategies which big picture kind of a thing besides stocks and real estate?
That's a good question, and there really aren't a lot of options. Having your own business is great, but that's not as simple as buying and selling stocks or bonds, which are securities. They're actually, pieces of paper that you buy with promises, but they're very liquid. You can see the price every day. You can sell them or buy them when you want. And real estate, same thing. You can buy it You can buy stocks that are in real estate. But the biggest gains and the biggest losses would be doing it on your own and owning the real estate outright. But there's work involved in that. There are commodity mutual funds, which we do tend to use a little bit. And of course, there's bonds, and there's different kinds of bonds. Some that do well when interest rates are rising, but most that do well when interest rates are falling. So having a side hustle, I think, could give you a lot of benefits tax-wise and how much you can put away on a tax advantage basis, as well as writing things off. So I'm writing off an RV for our family nature retreats work and the new satellite antenna that I got for Starlink, which helped us a lot last week because we were out of cell range. So it's kind of fun. You can spend money on things that you want, but also are useful in your business. So anyway, that's a great question. Great question, and not a lot of great answers.
Thanks, Peter. I think you covered majority of the income revenue streams, which is what you essentially did, which was pretty good actually. You covered majority of the big picture areas where you can generate income, and also tax liabilities to reduce your tax liabilities. Thank you.
You bet. Let's see, Ash.
That was me, Peter.
Oh, that was you. I'm sorry. I'm not paying attention. I'm looking at one thing and not the other.
That's all right. I think you got 13K and you got excited.
Oh, I never get excited. No emotion, all rational. Yeah, that's me. So I'll upload those articles by the end of the call if I can. Otherwise, they'll be online, and they really are excellent, excellent articles. All right. We've kind of gone through some discussion here. Unfortunately, we don't have enough time to go through this as a group and then talk about it. What I would suggest is get online and let's have some online discussions this week about where you see this, what structures you have in place to deal with these kinds of things. Do you set aside time when you're rested to study and to plan? And what could you be doing in advance? Mindfulness plays a big role in this, and curiosity. Mindfulness gives you that break between feeling an emotion and taking an action. You have a chance to intervene and bring your whole self to whatever decision you want to make. And we learn best and we have our best creative ideas when we're calm. They called it the still small voice of God, or intuition whispering to you. So finding that place of inner peace and building the structures is where you can start with this kind of work. And looking at those articles about ways to deal with these cognitive biases. So here's some broad areas. Automating your savings and investing, we just talked about. Slow down your decision making, we just talked about. Thinking Fast and Slow is a book that's about that. And diversifying the primary part of your nest egg to help protect against swings. We've talked a little bit about this, and I'll let you go online and share how you're incorporating these tips and ideas into your life. I looked for the things in common between No More Mr. Nice Guy and behavioral finance, and here's this avoidance of risk. Nice guys tend to avoid risk because they fear failure and disapproval. This can manifest as excessive conservatism, such as keeping money in low risk, low return investments out of fear. Fear of conflict, which means that we might neglect important financial discussions. And I had a breakthrough there. Yesterday, I had a conversation with an attorney. I'm in a lawsuit. I'm not in control of the spending, and it's enormous, enormous. But because I was willing to have a conversation with him, we cleared everything up, and we have a plan for going forward, which isn't ideal for either one of us. But the fact that I had that difficult conversation is something I'm very proud of myself for. And I did it in a very humble and transparent way. It worked out great. Emotional spending, that's another one I fall into. It's like, I've been a good boy, I deserve a reward. Oh, that's really me. And scarcity mindset. We could do a whole session on this. What you see is based on what you believe, not the other way around. We create our reality with our words and with our beliefs, and we should stay open because reality is really quite complex, and we don't want to be rigid, and we want to have our eyes open when good things or bad things are coming our way. I think with the gratitude that we talked about at the beginning and an abundance mindset, oh my gosh, all of a sudden then you're allowing your mind to open up. And often nice guys lack boundaries, including around money. Holy shit, been there a bunch of times. Somebody asked to borrow money or invest it or something. Here, here's my wallet, take it. So got some book recommendations here. I have a third article that includes a lot of books and articles that are listed. Remember, you can go to chatbots and you can ask them to summarize books for you. And then you can have a conversation. Oh, that point was really interesting. What does that mean? Or how could you tell me more about it? And you can have your chatbot speak to you. So you could be driving to work, commuting, and better than a podcast, you can be having a conversation with a book or some as you're driving, as things occur to you. These are the two guys that I was drawing on for this presentation. It turns out that I know several of the experts that I found in my research, including Meyer Statman, which is amazing, but I've been in the business for a long time. But he's here at Santa Clara University, and that's me. So next week, we're going to talk about the mindset of resourcefulness. Maybe even more favorite than behavioral finance for me. Any last minute questions, comments, complaints, brags, anything? Philip, you're the first.
Yeah, just wanted to share what would have been my answers in the group exercise, where in 2004 or so, around that, I led my family. Well, I went and got, along with my siblings, to borrow nearly $400,000 at that time to finance my adventure into Hollywood and LA and all that. And it all went tits up. So, but the next 5 years, along with the financial crash in 2008, taught me a lot, forced me to sit and learn about finance, get smart about finance. Even though I have an undergraduate degree in economics, it humbled me so much. I'm thankful that happened at that time. Wanted to share that.
Yeah, I grew up in LA and everybody's got an idea, producing a movie, whatever. Yeah, we learn, and that's okay. It's okay. I didn't give everybody explicit permission to leave the call, but we are at 11 o'clock, and if I had my druthers, maybe I would do these 90 minutes instead of 60. So there's a lot to talk about. But I thank you all for coming. I thank you all for working with me with my strengths and limitations. And happy breakthroughs. I will look forward to talking to you next week. Everybody's got
Thanks, everyone.
Thanks, you. See you next week.
Thank you very much.